everyone, welcome to Tax official YouTube channel.
Today, we're diving into something super important, especially if you own rental property or are planning to invest. Capital expenses versus revenue expenses and why knowing the difference can actually save you money. And if you're a landlord, trust me, you don't want to miss this. Alright, so first things first, what's the big deal about capital and revenue expenses? Well, understanding them properly not only helps you with tax reporting, but also when you're planning for long-term property improvements. So let's break it down first. Capital expenses are the big stuff. Things that add value to your property. They're not deducted from your rental income right away, but they can lower your capital gains tax later when you sell. For example, adding an extension, installing a brand new security system, upgrading the whole kitchen to something way fancier, building patios or fancy garden walls. Basically, if it makes your property better, it's usually a capital expense. Revenue expenses, on the other hand, are all about the day-to-day running of your property. These are deducted from your rental income right away. Think things like letting agent fees, utility bills, gas, water, electricity, insurance premiums, service charges, and professional fees, like your accountant. Simple way to remember, if you're just keeping the property going, it's revenue. If you're making it better, it's capital. One mistake a lot of landlords make is trying to deduct things like capital improvements directly from rental income. Remember, you can't, but you can use them later when you're calculating your capital gains tax when you sell. And hey, don't forget about the little stuff too. You can claim things like cleaning costs, garden maintenance, accountant fees, advertising your rental property, even part of your phone bill if you use it for managing your rentals. And when it comes to the mortgage interest, only the interest part is deductible, not the full mortgage payment. Also, when you replace furniture like fridge, beds, or kitchen stuff for tenants, that can sometimes be deductible too, under something called replacement of domestic items relief, but only if it's not an improvement and it's just a like-for-like swap. So, in short, good records equals to good tax saving. Always keep your invoices, receipts, and a simple log of expenses. And if you're ever unsure, it's always a smart idea to check with a tax professional. If you found this helpful, give this video a big thumbs up, and if you have any questions, just leave a comment down below and I'd love to help you out. I'll see you in the next one.